Hello, everybody, and welcome to this webinar. And thank you very much for joining us today, whether it's morning where you are, afternoon where you are, or the evening where you are. You're very welcome to this webinar. Just to introduce myself, my name is Howard Manton, and I work for the AU Group. And my role today is to open this webinar, to introduce our guest speaker, and to moderate, because we are going to be having questions from participants if you so wish. So it's my pleasure to introduce to you today Ludovic Subran. Ludovic, as you might have seen from the invitation, is the chief economist of the Allianz Group. I think Ludovic's right, you first joined Euler Hermes in 2011. So Ludovic has a particular fondness for trade credit, despite being the global chief economist for the Allianz Group across all classes of insurance. I just want to emphasize Ludovic's time today is going to be spent on the global economy rather than the underwriting stance of Allianz Trade. So I will try and avoid any questions, Ludovic, relating to the strategy of Allianz Trade. Prior to joining Allianz, Ludovic was with the French Ministry of Finance, the United Nations, and the World Bank. So extensive experience in many different organizations. Ludovic is fluent, I hasten to add, in 7 languages. So I'm in awe of that skill. And thankfully, especially for me, Ludovic has agreed to present today in English. And we recognize that for people who are participating on this call, English might not be your first language. So Ludovic and I will try and make certain that we speak slowly and clearly so that everybody can understand. Just some housekeeping, if I may, before we start. You will see that all of you are muted. And we have arranged for Ludovic to open with a presentation on his views of the global economy, but you will also be able to ask questions. And if you look at your screen, you will see at the lower right-hand side, there's a box for Q&R. So if any of you have any questions you would like to raise with Ludovic, if you can write your questions, type your questions into the box. I've got colleagues close by who will be receiving those questions and will be giving them to me so I can ask Ludovic the question. You will see the title of this webinar is Winter is Coming, and that's the snowy background that both Ludovic and I have on our screens. I think any of you who have seen Game of Thrones will have probably known that winter is coming. And for many of us in the Western world, as we enter into autumn, the winter season is coming. And certainly there's going to be a shortage of gas coming from Russia as a result of the current conflict. But in a wider context, winter is going to be impacting economies globally. And we'll be interested to hear from Ludovic how he sees governments responding to the crisis. And just from a note from the UK, Ludovic, you might touch upon how you've seen the UK government handling the current crisis and the impact that it's had. So with that being said, Ludovic, I'd like to pass over to you to take us through your view of how things stand at the moment and your forecast for the future. Thank you.
Thank you, Howard, and hello to everybody today. So I will try to speak slowly, even though I have a problem doing that in any of the languages I can speak fluently. But so if I'm not clear, just don't hesitate to ask. So I'm going to present for 30 to 40 minutes, trying to brush out most of the key elements we see on the horizon. Some very cyclical and short term, some a bit more midterm. There's going to be a bit of European centric bias in the presentation because the global outlook is plagued with basically 3 factors: the energy crisis in Europe, but that has bullwhip effects across the globe; policy mistakes, which to a certain extent is a form of determination by policymakers to treat this crisis a bit differently from past crises, but that has strong consequences, including on the insolvency outlook. and then the uncertainty and the risks. And especially, I will try to spend maybe a bit of time on what I think is also some of the structural breaks that have been happening in the economy, and that have a form of consequence on the backdrop against which some of the you as our clients or as some of our partners operates in the coming future. So the first message is very clear. I think in our team we are convinced that we cannot avoid a recession anymore. There is the theoretical kind of long-term explanation. I personally very strongly believe that putting the world on pause for 3 to 9 months in 2020 and throwing a lot of money at the problem, and having such a wonderful rebound and reopening in 2021 is actually, showing its limits, in the sense that I really believe that we are still absorbing some of the COVID pandemic. We try to avoid protracted recession, unemployment, and insolvencies at all costs. So today we have a lot more debt and a lot more inflation. And of course, on top of that, you have this compounding effect of the Russian invasion of Ukraine, which is a terrible um, geopolitical manifestation of, something that has been brewing for quite some time, especially since 2014. But I would not decorrelate this to the pandemic. I really do think, for example, that the way we're handling the response to the war in Ukraine, or the cost of the war in Ukraine, is also vastly affected by the fact that most of our political leaders are still under some form of PTSD of the very domestic policy making they've had to put in place throughout the COVID pandemic. So that's a bit, I think, the midterm or the more theoretical background. But in practice, what we see is that the recession in Europe is really at the corner. We have a contraction of trade, we have a contraction of manufacturing, and of course, for our economies, the price of energy has fed already through price of production and price of consumption, and has created this incredible situation in which today real disposable income of households, margins of companies, are very affected by the environment. And the price environment, the inflation, is really biting the decision, the confidence of a lot of the economic agents to a certain extent. So that's really the main driver behind the recession in Europe. But of course, what you can see from our forecast here is that we also expect a recession in the US in 2023. And this is not because of the energy crisis, though the cost of living crisis is having an effect, but it's mostly because of the handling by the Fed today of the overheating of the economy that has been caused by the Great Intervention. The fact that we decided to sign checks and send checks to all the households in America, that has created inflation in the US and across the world. And now it's the job of the central banks to actually tame this inflation. But they're really going over the board in a way. So to fight inflation, the Fed is determined to raise interest rates super high, 4%, maybe 5%. And of course, this is creating an unprecedented tightening of financial conditions. And this is affecting the lending to the economy, the housing market, and also the cost of credit for companies. And so we see in a lot of countries in Europe and in the US, for companies, cash eroding and cost of lending increasing very fast. And this is, of course, the beginning of the recipe for a contraction and a recession. I will talk about China. The Chinese economy is, to draw a form of parallel, is a bit like the real estate crisis we had in Spain in 2008, 2009, like Japan had in the mid-90s. The domestic economy in China is depressed for quite some time because of the real estate crisis that got circumscribed to China, but to a certain extent is having a rippling effect throughout the world by the lessened Chinese demand, right? And the fact that in 2023, lesser Chinese demand, even though the headline number may be at 4.5, lesser European demand and lesser American demand is creating the recipe form a formal recession, even though the ingredients of these recipes are very different from country to country. This is partially important why, and just a word on zooming out to the Southern Hemisphere, right? I think the World Bank and the IMF are holding their annual meetings as we speak in Washington. And the big risk today is that some of these large emerging markets are really at a crossroads. Some of them have political uncertainty in the making. I'm thinking, of course, of Brazil, for example. Some of them are at war with, a good quarter of the world, as the case of Russia. Some of them are really affected by the higher energy bill. Some of them cannot export as much of commodities that they used to. Some of them have extremely tight access to financing, and some of them are already in default, like Sri Lanka. So we have listed, and I will come to a minute. We're very concerned also about the cascading debt-related defaults in the emerging world, as all of these engines of growth are a bit, muted. And so that's why, yes, we don't have a very positive or very optimistic outlook on the horizon. One good news is that if you look at our forecast, we don't expect the recession to be neither deep nor protracted. So you don't see here the 2024 numbers, but we see already a comeback to positive territory in 2024. Why? Because first, I won't try to make any prediction on the war. I won't try to make any prediction on the U.S.-China rivalry, even though my personal guess is that both of them are here to stay. But clearly, there is still a lot of resilience embedded in the balance sheets of households and companies. There is still cash. There is still a form of buffer that could cushion a longer or deeper recession. And the second hypothesis behind the fact that this recession is not catastrophic, it's not like a big financial crisis, it's not like something commensurate with global recessions we've seen in the past, is the fact that policymakers won't let that happen too much, right? So if you think central banks today are really tightening very fast, think about central bank as early as 2023 that gonna pause because they don't want to break the financial cycle. Think about ministries of finance that may actually chip in again to make sure they offset some of the cost of the war, of the energy crisis on households and companies in Europe. Germany just yesterday announced another vast package to offset the cost to the manufacturing sector because of the jobs at stake, right? So there is this, uncomfortable 24 months horizon, maybe 18 months horizon. But to a certain extent, that means we're going to have a form of triaging recession, where those companies, those countries that have accumulated vulnerabilities will be particularly exposed. And those companies, those households that have built buffers and are taking action to limit the damage will actually be okay. That's a bit the message here. Selectivity is back, discrimination is back. I will go a bit faster on the following slide so that we have time for Q&A. The next slide is maybe on trade. We expect a double dip of global trade. So in 2023, we expect a contraction in value terms of trade, mostly because of this lesser demand from the big countries, but also because we start to have leading signals from the inventory situation of companies. Remember 6-9 months ago, everybody was talking about shortages. Well, there is something that people are not talking about today, which is there is too much stocks, right? And this is because the order books has deteriorated faster than supply arriving from the past order that have been made have actually come to the warehouses of companies. And this is important. Why? Because it should create a form of a cap on inflationary pressures, especially on production prices, on even though they will still be quite high because of the energy cost, right? But it should also create a form of a new phenomenon for working capital management, which is managing stocks, managing days of inventories, which is such an essential part of working capital requirements and financing of the liquidity at the firm level. And so I really wanted to show you those two aspects. First, trade is going to be a bit in a downturn mode after a very strong reopening and very strong recovery. So there is still, a lot of friction on the upside as well as there will be on the downside. But at the same time, the very situation of companies is of companies that have today, they have to manage overstocking. The past hoarding behaviors are now something that have to manage on financing their operations. And so that means that we're going to have to also live with a very different situation, especially in the intermediary goods sector, because some of these firms are going to be taken in the form of, they're going to have to continue to sell, but they're going to have also to make sure that they keep resilient should there be a new reopening, right? So you're going to have a bit of a different situation than we had in 2021, where nobody had stocks. Nobody had to manage the derating of the currencies. And this time around, for example, we see very successful companies that have piled up stocks in dollar terms and that are now extremely well positioned to be able to benefit from the more expensive dollar and still the order books and basically take some market shares from the competitors because they manage stocks in a much smarter way than the competitors. So, right. So a macro topic and a micro topic that I think are important to understand the situation on growth and revenue growth, especially export growth. Whether there is still a lot to make for most companies, but with a bit more headwinds. And on the micro side, this idea of inventory management that is going to become so critical to working capital management. On the next slide, I want to talk about inflation. We still have very high inflation comparatively to the past 10 years or even the past 15 years in most countries. So on the right-hand chart, you see a bit the profile of our inflation forecast for the US, Eurozone, and the UK. Why I wanted to show this chart is that you hear a lot of people saying that inflation is going to stay high for a long time. You always have to ask, what is high and what are the assumptions behind this forecast? The peak that we are in or nearing is not sustainable. Ex ante, we should all be worried about inflation, but ex post, all policymakers have their hands on deck, right? Everybody's trying to keep inflation, including by creating a recession. And so, by the sheer construction of demand, by the increase of interest rates, central banks finally doing their job, also by stabilization at high level and with a lot of volatility of some of the input prices, we should have a mechanical, decrease of inflation. But what is interesting in this graph is the endpoint in 23. Even if inflation gets back to, 3% Europe and 4% or 3% also US, actually, we have for the Eurozone as a whole 5.6%, which is quite high for 23. And so it will only be back to 3% by 24. What is interesting here is that we still continue to believe that in the foreseeable future, there's going to be at least 1 point of inflation extra as the average for the coming year. So even though the peak of inflation is going to be killed by policymakers doing their job and maybe by the very unfortunate recession that is being deliberately caused by policymakers, we believe that the price level is of course going to be much higher, and the inflation is a price change, but also the pace of price variation. So the inflation rate is going to be maybe 1 point above what we used to till 24 and 25, right? So there is and mostly because of the 3Ds: demographic, decarbonation, and deglobalization. And I have to qualify each of these terms. I don't believe in deglobalization. I think we have never been that globalized, but I believe in a form of fragmented globalization with frictions, with costs. And so that's clearly costing, trade is not as deflationary. Global trade, China is not exporting deflation as it used to. Decarbonation is clearly a bit more inflationary than we had expected. This is what the war in Ukraine is showing us as a real life example. And the demography and the idea of how to incentivize people to get back to the job market is one of the biggest questions of our lifetime. The beauty of home office without really understanding the inconvenience of home office, the tensions in the labor market between blue collars that cannot remote work and white collars that have all the benefits of the world, that being able to this is creating an unprecedented structural break on the labor market, and I think this is going to create a bit more tension on wages, and certainly a demand by wage earners to get their fair share of the whatever it takes measures that government are going to take, that maybe in the past 2 years have been excessively saving capital, productive capital, and not enough benefiting the average wage earner. So there is a rebalancing that is happening here that is going to cost a bit of inflation. As I said before, the big issue here is what are central banks doing? Because compared to at least the global financial crisis and the pandemic, where central banks have been extremely supportive, this time around, central banks say, wait a minute, I have to somehow help tame overheating. That's for the US. And that's why the Fed has been very decisive in increasing interest rates. And in Europe, also because the Fed is doing so, but also because Europe is also trying to force a form of demand adjustment and avoid, we're going to have 10% inflation in the Eurozone, right? That's something that is creating necessarily social unrest, right? So the ECB is also on this path to increasingly tighten the monetary and financial conditions, while managing a bit some of the liquidity concerns or the financial stability concerns. Howard, you mentioned introduction in the UK. The Bank of England intervention is a good example of what the central banks has to do while they tighten to face inflation. They also have to deal with some of the financial actors that cannot stomach such an abrupt increase in interest rates, because the model is put under a lot of duress. And so what is interesting here is both central banks are actually tightening very fast, and changing a bit the rate, the interest rate environment paradigm in which we've been for the past 10 or 20 years. And this means that this is going to, of course, affect lending, the cost of lending, which is very important for companies. We see already spreads for high yield companies, for example, increasing very fast. This is increasing, of course, the debt servicing cost for governments and for companies. You have on the right hand side of the chart the table with many countries, because every country has been trying to tighten. Very few countries are in loosening mode right now, apart maybe from China and Australia, in the world, and Turkey. Most of the countries are in tightening mode, and so this means that everywhere in the globe, governments, companies, and households are borrowing at much higher cost, right? Our expectation is that central banks will continue to hike as much as they can, but basically they will be taken back by gravity. So as soon as recession really starts to be ingrained, and to avoid that the social cost of this recession in terms of jobs, in terms of access to financing, in terms of access to credit and financing investments are too strong, my personal and our personal belief in the team is that central banks are going to pause and then maybe even have to cut rates. This is not what markets are pricing in right now. Markets are pricing in the Fed to go as high as 5% and the ECB to go as high as 3%. That could be happening. This is not our expectations, because I really think that there will be this arbitrage between growth and inflation management is going to be too strong, and won't be supported by central banks operating in a silo without looking really at the distributional effects of their policies. Remember, just 1 year ago, a lot of people were thinking that central banks were there forever, and we have one of the strongest energy crisis and cost of living crisis of the past 20, if not 40 years. I cannot believe that central banks could actually create a recession, a deep recession, without changing course of their rates. But that's a strong call here. And again, as I said, as we look at financial markets today, they have not priced in as much of a recession as we've priced in. So there could be strong adjustments, especially in the equity markets. And if we look at expectations in terms of terminal rates of central banks, I think we are more on the dovish side. because we expect the recession to bite a bit central banks in the back as they try to really hike, and basically we start to see liquidity cracks everywhere. And I guess the UK is a case in point, but also in some emerging markets, the risk of currency derailing has been very strong and on the mind of a lot of policymakers. So they've also hiked. But as I was in Asia last week, and you can see in a lot of Asian economies that now they are suffocating the domestic lending in the economy. And so this is creating another set of issues, especially in the housing market. This is creating another set of issues in the investment of some of the firms that cannot, stomach, because of the very low revenue expectations, a debt servicing cost that increased by 1 point of EBITDA or 2 points of EBITDA, which is in the case of some of the countries we're talking about. As I said before, central banks basically passed the baton to ministers of finance, saying the pandemic, we saved the day. We gave a lot of credit so that the economy will keep on functioning, liquidity provisions, right? This time around, it's an energy crisis. Let's not go through the debt nexus, but you guys can do cash to cash measures. And governments have been hearing the message loud and clear. In Europe, in the past 6 months, governments have spent 250 billion of measures to cap prices, support households, support companies, as an example. The problem is the way they've done it is in a very unsustainable way, meaning most of the measures have actually not been very targeted to the companies or to the household that most needed it. And so the problem is, because the cost of financing for these governments has been super high. In France, if you look at the 10-year debt issuance by France, it's above 2.5% when it was 2 points lower just a couple of years ago. So you imagine the cost in next year's budget. But just imagine the cost in 10 years, because compound interest rates apply also to this type of debt, right? So you're going to have these arbitrages between, spending in education and spending in debt servicing, debt repayment, right? So you can imagine that my main concern, and we can discuss about the specificities, for example, of the power market in Europe, the specificities of some countries that have made maybe smarter choices than others when it comes to the fiscal measures. The problem now is that the governments are borrowing at a much higher cost. And so either they make some massive improvement in terms of quality and efficacy of their borrowing, or we run into a very strong concern about debt defaults of countries, right? And that's when, again, central banks have to do something. So you see there is a Faustian pact between fiscal and monetary. Fiscal is now in the lead. We're going to have to reinvent a lot of the rules, especially in Europe, because apart from Germany and maybe Ireland, I don't know which country will be on track with Maastricht criteria 5 years down the road. And even, Germany, who is always, has always been a bit the guardian of the debt temple, they have been spending like there's no tomorrow. They're just hiding it away because constitutionally they cannot increase their debt levels above 0.35% of GDP when it's about structural debt. So that's why they're creating all this funds. So every government is spending to avoid social unrests, but the cost of this spending is going to be a long legacy of this crisis on the public finances, and therefore on some of the choices on how strong governments are going to be in 3 years, 5 years, 10 years from now. I mentioned the emerging markets conundrum. The slide has 2 charts. One is about which emerging markets are at risk on the x-axis of liquidity, so basically access to financing, and on the y-axis on the recession. And so to keep it short, and you have also a very specific example on the right-hand side on the food crisis, which, as you know, I know some of you are operating in this sector and are seeing the damages that the food market has had on some of the people and some of the companies in the countries you operate. But if I just look at the macro picture on the emerging markets, we are very concerned about Argentina, Kenya, Ghana, Tunisia, a bit also about Romania or Hungary. We're also a bit concerned about you know, we've seen already Zambia, Ecuador. We've seen countries being a bit under duress, but we see more of these emerging markets, Turkey, Egypt, which are also under a lot of stress today. And to be fair, I'm also very concerned that because most of the countries that are the creditors are worried by their own problems, be it China, be it G7 countries, their ability to once again write off some of the debt that these emerging markets are issuing so that they can still access market is going to be less than what it used to be when they were expanding. So that's also why there is a bit of a confluence of risks on emerging markets. Not everything is bad. You can see here many emerging markets on the lower end quadrant that are doing great, either because they're commodity exporters or because they did the right choices when it came to a fiscal discipline, or they've been trying to address their structural reforms in a bit more forceful way. But you still have, you know, I already also see Pakistan here. I see Colombia and Chile, for example, that used to be in the good quadrant that are now a bit in the risky quadrant. So now I go to what you guys are interested in, which is, you know, and our specialty at Allianz Trade, which is what does it mean for companies. And here I have just a summary of you know, we have on a quarterly basis, we update our underwriting stance at Euler Hermes based on what my team produces, which is an outlook for 20 sectors in 70 countries. So that's, as you can imagine, a big matrix where we look at demand, profitability, liquidity, and business environment risk for all these countries and sectors across the globe with our 2,000 risk analysts around the globe. And so here I just wanted to summarize the risks that I just mentioned to you: higher cost of debt, energy crisis in Europe, recession, strong dollar, further increase in non-energy commodity prices, and political risk. And I just wanted to, and I listed here those sectors where we are a bit more worried that it could bite the revenue, profitability, liquidity, and overall resilience of the companies of these sectors, right? So you can see a lot of the sectors are in Europe because the energy crisis is a supply crisis. And so, of course, you know, if you have to stop producing because you don't even know at which cost you're producing, I can tell you this is having a domino effect on your suppliers. But you also see here some sectors that are particularly over-indebted. You know, so some sectors here where there is a confluence of higher wage bill, higher energy bill, and higher financing bill. And so this is for some countries, and we've seen already some names going bust, right, in the past 12 months. So there is this risk that is brewing, sometimes, you know, affected or counter-managed by, you know, public intervention, but sometimes it's just too late or too little. And remember, and this is, of course, the most interesting, you know, when you look at, and here I chose 3 countries, but we do that for a lot of countries in the world, we try to look at those fragile SMEs, right? Those SMEs that actually made it through COVID, but mostly because of the public sector support, but whose business model is basically not very sustainable. And if I just look at how many fragile SMEs could tilt to, I'm not able to pay my suppliers because of the energy bill increasing by 50%, which is in some countries, and Howard, you mentioned the UK, already more than this. We're talking about an increase of, you know, 3 percentage points for the UK. So 20%, 1 in 5 SMEs in the UK could be considered as fragile. So which is, you know, before we talk about insolvencies, 14% in France, 7% in Germany. And so this is this is to some extent, this is different than in 2019 before all this crisis happened. And for Germany, for example, it's less. We still don't know if companies will decide to just close shop or close shop with an insolvency proceedings. That means they leave debt on the market. So because some of the companies have accrued cash and could decide to pay off the suppliers and then close shop, that also is why we don't see insolvency numbers pick up, because sometimes it's just you close the company before it becomes an insolvent company. But as you can see, the picture is that there is a normalization of credit risk in 2022 already in many countries. In 23, we expect this to actually be much more visible in the non-payment risk, and we start to see a bit of move on the claim side. The team at Subran is managing that with a lot of granularity and precision. So I hope you don't feel it in the risk underwriting stance. But this is really something that on the aggregate level is quite interesting. And so there are two options here. Either governments say, okay, you know what, we cannot support as much as we did during COVID. And so there's going to be, the good, the bad, and the ugly. Or we do again whatever it takes. I think my answer to this is I don't think they're going to do whatever it takes again. So we're going to have to bite some of the bullets, and so that's why we have looked at cash buffers, which are still quite high. So that means a lot of companies can still go through this perfect storm without being too damaged. We looked at the cash burn and trying to understand how much we're talking about, so that we had the environment, and then we have the specific the increase in the inventories that contributed to 2/3 of the increase of the working capital requirements. Talk about a cash burn here. You remember my inventory glut that I mentioned to you? This is massive. Days in inventory increased by 7 days, and you know how it impacts the working capital financing and the overall payment situation between companies. So when you look at the cash buffers, we end up with this insolvency forecast that you see on the on this chart. So we looked by sector, where we saw already an increase of insolvencies. Here you have Europe on the left-hand side of the chart, and you have we also monitor the big insolvencies. So we look at the sectors where we remember the vulnerable sectors. We cross that with the sectors where we already see insolvencies pick up, and then we look at the big ones to try to get the domino effect on supplier, and that gives us those numbers. And so I will finish off with that. Those numbers here are basically our insolvencies forecast for most of the countries where you're operating. You have the absolute value, and you have the change, and you have the forecast. What do you see? You see a massive increase, which is a normalization, because it was such a low and bizarre number. So here you have 38% increase in the US, because we have this expectation of a recession. 20% in Canada, 22% in Brazil. So that's the fourth column after the country name, right? And so we have this normalization most of the time. So in some countries, we already exceeded pre-COVID levels, but in most cases, the numbers look big, but it's just going back to this triaging function that has been completely annihilated by government intervention. So in our scenarios today, we have some fiscal interventions, but there is a bit of a market forces that apply. And so those companies that accumulated bad choices and a particular sensitivity to an adverse environment are actually, being in a very difficult position, and we expect them to show some form of distress, right? So if you look at the numbers, that is, if I take France, for example, we're still around 53,000 insolvencies. Remember, before the crisis, we were more around the yearly number of companies going bust around 60. So it's still quite low, right? So that means the massive transfer of money from public to private has helped somehow a lot more companies than expected, to the point that today we have to, when we look at the credit risk, when we open the balance sheet and P&Ls of companies, we really have to take into account, for example, their behaviors when it comes to reimbursing the state guaranteed loans, their behaviors when it comes to paying their payroll taxes to the Social Security Agency. That's for France, for example. We have to look at, for Germany, how affected are they by their over reliance on gas. We have to look in the retail sector by the environment when it comes to wage price loops. So this is very interesting, and maybe one slide which is again more philosophical to end, and I won't go into the details, but what is interesting here is we are in a different environment. We have a great disentangling. I don't want to talk about deglobalization, but we have clearly a more friction world. So in our world of trade insurance, we need to continue to say trade is not dead. Trade is changing, so we need to adapt the way we insure trade. We've seen a great widening, the inequalities that I mentioned before, and especially the fact that wage earners are particularly worried about the inflationary pressures. We are clearly embracing the great greening in a different way than we had in the past, a bit, cut back by the very topical circumstance of energy security. So in Europe, at least, we were already on a very green journey, but we are accelerating, not really doing the best thing because we're still subsidizing a bit hydrocarbons, but to a certain extent, energy and climate security are intertwined. And the number four is maybe most important. The number five, I mentioned the dilemma at hand for central banks. Number six, I could talk for hours about the choices or non-choices that the European Union are doing. But I want to zoom on number four here, state intervention. We are still in a world where the public sector is very overstaying its welcome. What do I mean by this is that we still have, in a lot of sectors, very strong fiscal subsidies that explain why some companies are still alive. And so this is a new factor in after 20 years of, I wouldn't say that the public sector was not present, but I would say the public sector was parsimonious. Since the pandemic and now the war, and now in the face of cyber attacks and climate change, we see a comeback of public forces in determining the credit risk of businesses that is, I've been doing this job for 20 years, unheard of. The only country that I know that has been doing it is China. So we all a bit going into a form of command economy and state capitalism. And so what does it mean? It means that, of course, you look at the financials of companies, but you have to look at political risk, climate risk, regulatory risk. You have to look at fait du prince, basically the decisions that governments are taking that could make or break an entire value chain. And this is when you do country risk, and we do that at Allianz Trade for quite some time, you're used to it. But I think explaining to our clients and to the B2B trading ecosystem that this is sometimes the main factor more than the last 10 years of profitability or the past 5 years of liquidity positions, that is the single element that can really create an insolvency wave, is, I think, a very new environment in which we are operating. And that is also, calling on all of us to continue to monitor with granularity and to be able to adjust and react to this fast changing environment, because a policy decision, as you can see in most of your countries, is much more fickle than the business efforts you've been putting into making a company successful for years and years. So that's, I will stop here for today, and I thank you again very much for your attention. And then with that, I pass the floor back to Howard for the Q&A.
Ludovic, thank you very much indeed. Most informative. Can I just take you back to your slide about insolvencies and your sort of predictions, and you're saying getting back to similar levels of pre-COVID. During COVID, the name zombies was used to refer to some of these SMEs that were only being kept alive due to government support. Whilst there might be an increase in the number of insolvencies, I would anticipate that most insurers would have pulled out of covering those companies and are not back in. Is that your perception?
This is clearly my perception, and those of you who have been faithful and loyal clients know that, especially at Allianz Trade, I think we've been looking at these zombies even earlier than competition, which has been a big bone of contention, I know. But I would say that the risk profile of our portfolio, and I hope as a result the risk profile of the trade receivables of our clients, is a bit better than it used to be in 2019. The good news on the zombie front is that the share of zombies in the economy has not increased.
Okay.
Right? But the external environment against which zombies are trying to grow has deteriorated.
Sure.
So if you've been pruning zombies, and I mean, it's hard to tell someone, well, don't trade with this one or that one because he's a zombie, when you basically just want to grow your turnover, right? So this works in theory, not in practice. But the idea of pruning zombies, or at least improve credit management practices when it comes to dealing with zombies is something that I think we've been trying to help our clients. That's the prevention function of a good credit insurance company. So you're right. I think most of the companies that entered the crisis in a very bad position, we've alerted our clients about their dealing with them. And today, as you know, our risk appetite has increased on the back of the very strong recovery of 2021 and has been sustained on the back of chaotic 2022. This is where we take pride. We take pride in thinking that we've been good at discriminating the good, the bad, and the ugly. And so that even though the environment is much more adverse, normally the residual risk that our clients take with the risk transfer function that we offer to them should be under control.
Okay.
So that's my understanding of the situation. Of course, the problem is indeed how systemic and exponential the energy crisis is affecting a lot of sectors,
Sure.
or how fast the deterioration of financing conditions could affect, for example, the construction sector, which has historically been a major contributor to insolvencies
Sure.
and which has been completely muted for the past 2 years. Right? And of course, we all see now the cracks in the housing sector. In the US, transaction volumes are down, prices are down. So there is a bit the sense that we could have yet another difficult situation for the housing sector. And we know it's one of SMEs, it's one with longer payment terms than the average sectors. So these are the type of environment of focus that we have. And of course, the energy intensive manufacturing sector is another one, retail and transport, because they are very affected by the current environment, labor, debt. So we're trying to be extremely targeted in terms of understanding who in this sector is particularly at risk as the environment deteriorated dramatically over the past 6 months.
Sure. Just a question on the dollar, because that was something that you covered and mentioned during your presentation. And historically, the US dollar has been a sort of safe currency, flight to the US dollar. The dollar is very strong because of the action taking to curb inflation. Do you see the dollar and its exchange rate is affecting many currencies globally? Do you see the dollar peaking in terms of its strength? And what would you see as the impact of the dollar remaining very strong? Or if the dollar did reduce in value, would that have an impact upon the rest of the economy globally?
I think the very strong appreciation of the dollar is one of the reasons for the liquidity issues we start seeing across the globe. So behind the hard tightening and the hardening of financial conditions, you have what central banks are doing, but you have in particular the appreciation of the dollar, especially for those countries, those companies that have revenue which is in a different currency and that have all the liabilities in dollar, right? So the dollar strength to the other currencies, because it's really the dollar strength, right? The euro, for example, is not weak. It's the dollar that strengthened so much, right? So I think, and this is the same to the dollar pound. This is the same to basically the all the currencies of the trading partners of America, right? So behind the dollar peak, which for us is a peak, meaning our expectation, for example, is to the euro, for example, that we get back to 1.10 euro to the dollar by N23, right? The
Mhm.
reason behind the dollar peak is threefold. Is it's a safe haven. So as people are worried about a recession, they flock to the US. It's the very strong determination of the Federal Reserve to hike, which creates more interesting returns in dollar terms for investors across the world. So again, it's a bit of a flocking, and it's the terms of trade that are so negative to many countries that are not, like the US, energy independent, even though the US has a very weak form of energy independence. But of course, in the midterm, you see that starting to be priced in. There is this, for example, to Europe, there is this realization that the trade surplus that Europe has been running with the US for, I mean, with the world, but in particular with the US for quite some time, is melting like snow under the sun because the price of energy is so high that, and the price of trade is so negative to Europe because we import energy and we export other stuff in euros and we import energy in dollars. We have and for the US, we are reducing our surplus with the US, right? And to be fair, in the medium run, one could ask whether the US, I don't think the US will ever run a form of surplus, but clearly the net position of the US could be slightly better than it has been for the past 10 years, also because they're going to be energy rich. Just think about capital going to the US, just think about production going to the US. I stopped counting the number of clients who are thinking about locating their production plants in the US because they can secure energy and they know that energy could be cheap. And so if you are in the glass making, in the aluminum, those sectors where energy is everything, you may actually decide that you want to relocate some of your production to a country that has some energy supply because Europe doesn't have its own energy and it will take 5, 7, 15 years to actually get to a form of, energy sovereignty that is palatable for some of these economies. And even with that, in some of the sectors, you can be energy independent in power, but you may not be in gas. And for industrial sectors, gas is essential, and they haven't yet crossed the innovation frontier that make them independent on gas. And think about fertilizer companies, for example. So the US, and that's why there is this big US. I think as the forces at play that I enumerated today, materialize, I think that there will be, just by the sheer fact, for example, that the Fed pauses, or the sheer fact that energy prices stabilize to some extent, I think we could totally see the dollar going back into a range of $1.10 for the euro. What is sure is that, for example, to the euro again, but I still think the dollar is going to be strong. So I don't think we will go back to 1.3 or even to 1.2 because of the structural breaks that have been happening because of the war. The war with Russia is our Vietnam. It's going to
Yeah.
be for years to come.
A changing continent because sort of over to China, and this is sort of geopolitical as well as economic. What do you see as the future position of China, re-election, saber rattling with regard to Taiwan? What impact's that likely to have on the world economy?
Look, I think the party congress is going to be an occasion for for Xi Jinping to test again some allegiances, so to find a form of unity in the leadership of the country and maybe have some turnover on some of the dignitaries so that they all share a common perspective, because we have a tendency to see China as a monolithic bloc, but it's not. You are very liberal and very command economy inclined people, right? So, and you have people that are more open to the world and some that are less, more that are more belligerent toward Taiwan and some that are less, right? So I think Xi Jinping is trying to get a bit more alignment in the decision making. I think he's going to have to reassure on the common prosperity agenda, because what happened in the real estate sector is a big blow to the savings functions, to the pensions of hundreds of millions of Chinese. And he's going to have to decide what type of interface with the rest of the world he wants. You remember the dual circulation topic? We are at a tipping point. China stayed quite neutral when it comes to Russia invading Ukraine. China has big energy needs, so it is passively not neutral, just like OPEP is not neutral when they decide to cut production. So 75% of the world did not take a stance against Russia in favor of Ukraine. So we see that at play. And so for China, it's going to be what type of role do they want to play as a global hegemon, right? Do they want to deepen the relationship to a set of allies, just like the US called on friendshoring? Do they want to play a bit closer to Europe because they feel that they need the European consumer, and so their rivalry is with the US? Do they want to continue helping countries in their catchment area de-dollarize? That, for me, are going to be some of the discussions we have. Our personal take is one of friendly fire between China and the rest of the world. So, for example, we're really looking at the lessons from the world trying to deglobalize Russia, which is working partially. We think that we could be in a world in the next 3 years where the West is trying to lessen the influence that China has through a set maybe of financial sanctions. So I think it is very important, for example, that in the boardroom, the discussion about an needs to choose scenario happen, the discussion about circumscribing the US and the Chinese circuits from each other. Looking back again at where you consolidate in Asia, how do you play within the Asian markets with potentially more friction between Asian economies that have that will be called to pledge allegiance to either or. And so that's yeah. Unfortunately, I think the the war with Russia is a wake-up call for a form of exit from a strategic ambiguity when it comes to China. And so it is, this is maybe the new the great disentangling that I was mentioning. This idea that we've been so used to trading a bit frictionless with a lot of the countries, and to diversify, and whatever we were not making on one continent, we're making on another. Remember 2010-11, China saved the world. 2015-16, China created the recipe for a new recession. So it's very interesting to understand what happened in China, but you have to remember the second topic that I mentioned. China has to fend for its own first, and today the domestic economy is under a lot of pressure. And so, as I say, an extent, their relationship to the rest of the world is residual to their making sure that they have a solution for the domestic cohesion. And so that China may be much more inward looking, and de facto helping the rest of the world, for example, by calming down central banks, right? Because if China decelerates fast, inflation should also drop. And as a result, maybe central banks will be less amenable to create a recession in their own country, right?
Sure.
But it's not good when one engine of growth like China is not only faltering, but also keeping the rest of the world at a distance. And I think it's going to be confirmed by the Party Congress. Yeah.
Okay. Maybe time for one last question, if I may, Ludovic. Had one in from the participants saying, generally order books are seen to be decreasing, and we've already suffered a supply chain shock. Do you see there's a prospect of a demand shock, and how long might it last if you see that coming?
Well, that's exactly my first slide, right? I think we've been one of the first ones to call the recession because we just wanted to call a spade a spade. I mean, everybody has been talking about shortages, and we're like, wait a minute. When we talk to our clients every day, we realize that order books are deteriorating faster than their ability to get supplies. And that's because we are a micro-informed, economic research team, that we capture that, because the headlines are still not up to date. You still hear about shortages and so forth. It's true. There is still a shortage. It still take 18 months to get a car or whatnot. But it's not a shortage anymore when demand is plummeting faster than supply. And so for us, we already entered in a demand-driven shock at the, I would say as early as September for Europe, and we think that because of inflation still remaining high, this could happen at the end of this year for the US.
Okay.
So that's where we are in terms of demand-driven contraction in a series of countries. So GDP is a lagging indicator for us. So that's why also you see the contracting number in our forecast in 23, But basically the profile for 23, and if you remember the first slide, is one of the end of 22 and the beginning of 23 is cumulating, I would say, the lower momentum, whereas the second half of 23 is actually not too bad. That's the right hand side of this chart here.
Okay. Yeah.
Already we're in October, so we already see the demand-driven recession visible in China, Europe, and the United States, and then it stays extremely muted for Q1, Q2 23 before it gets back to an okay level in the end of 2023.
Super. Ludovic, we're out of time, but on behalf of all of us, and especially those who've been listening in without being able to express their appreciation verbally, thank you very much indeed for your insights today. It's been fascinating, and I wish everybody on the call a good rest of the day. Ludovic, thank you.
Thank you so much, Howard, and thank you, everybody. And have a great day, and talking to you soon, I hope.
Okay, take care.
Bye bye.